Hello, everybody. This is Chuck Carnevale, the Chuck in the Market's Up Chuck. And boy, do I have some incredible bargains to show you today. The first bargain I want to show is Aflac. Yes, the duck. Everybody knows the duck from the commercials. It's a terrific commercial. But I also want you to see what a great company this is. And what I've done here is I've stopped this company's I've drawn this chart only through 2007, which was actually the last period of normalcy. And what I've got on here using our FRAT, which is Fundamental Research Analysis Tool, you can see the plotting of Aflac's earnings over this 18-year period from 1990 all the way through 2007, which was basically a period of reasonable normalcy for this company. 2008, of course, hitting the big recession, which I'm going to show you later. But what I wanted you to see is how consistently the company's earnings have grown, as connotated by this green line. This company grew earnings at almost 20% a year. That's almost twice what the stock market has done. But look at this amazing statistic here. Look how the stock price has followed earnings growth over this period of time. If you look at this 18-year period, the black line on this chart now represents the monthly closing stock price of Aflac. If the stock price is touching this line, it's in value. If it's below the line, it's undervalued. If it's above the line, it's overvalued. But the point is, look at the correlation here. Look how the stock price over 18 years has followed earnings. And look how every time the price got below earnings, what a bargain it was. For example, in October of 31st of 2006, you could have bought this stock at just under $45 a share and watched it rise to $62 a share by December 31st, 2007. But the point is here that earnings determine market price. What's also amazing is with this 19.8% growth rate, if you look at how this stock performed on an operating basis, on a stock price basis over this 18-year period, you get an astounding statistic here. You'll see that Aflac's, if you put $100,000 in Aflac on January 31st, 1990, and held it through 12/31/07, or during that 18-year period, your $100,000 would have grown to $2,954,257.20. That's a 20.8% compounded annual rate of return. By the way, significantly better and bigger, than what you would have got if you'd have just put your money in like an S&P index fund, which the S&P index did about 8.3% during that period of time, where Aflac did 21%, not counting dividends, I might add. But the real point I want to make here at this level of this presentation is look how the earnings correlated to stock price. When there were short periods of time where it got disconnected, it always recovered and came back to its earnings justified level. As you can also see by this chart, Aflac has also traded at around 18 to 19 times earnings, which has been their normal price earnings ratio throughout this entire period. But you want to see something truly amazing? Look what happened after 2008 came in. All of a sudden, this company was trading at $67 a share. By the way, they had a tremendous earnings report in their fourth quarter. Or for the full year of 2008, they increased earnings over 15%. They did show a little hybrid securities, a little problem with some hybrid securities that panicked the market, and Aflac has fallen from $67 a share all the way down to $16 a share, where it was trading at as of the close of yesterday's stock price. But what's interesting about this is to show you how ridiculous this can be in the stock market. If you look today, and this will be current information as of just a few moments ago, Aflac was trading up over almost 20% today. As of just a few moments ago, and of course you never know at the stock market today how it's going to end up, but Aflac was up $3.55 or 22.1% at 11.17, and it's right now about 11.22. So the stock, a few prior to that was up 21%. This is one day. This is just what's happened to Aflac today and today alone on very, very high volume, and it just really indicates how cheap this stock is. You can buy this company today for under 4 times earnings, and you can get a 6.1% dividend yield. And look at the dividend record of this baby. If you'd have bought the stock back in 1990, you'd have started out with a 1.9% dividend yield, which is actually quite normal for this company over when it's trading at valuations that make economic sense. But today, because the price is so low relative to its earnings justified level, you're actually starting out with a 6.1% yield. And look what's happened to the dividend over the last 20 years. And by the way, in the fourth quarter this year, they just raised their dividend another 17%. They raised it from to over 96 cents a share, and so you're looking at buying the stock at $16 a share today. You're getting a dividend yield, and it's growing. You can't buy any bonds or treasury bonds or anything to get anything close to that. So you get a 6% yield and continued growth. The forecast for this company going forward by the leading analysts that follow the stock is for it to continue to grow in the future at over 15% a year. And even if it only traded at 15 times earnings, by the end of this year, you're looking at an $80 stock that you can buy at 16. And normally, the company would be trading at these values. At these levels, if it continues to grow at 15% a year and traded at a 15 multiple at the end of 2014, you'd be looking at a $142 stock and almost a 47% compounded rate of return. Wow, what a bargain. Aflac, one of the finest leading insurance companies in the world, can be bought at less than 4 times earnings with a 6% dividend yield, and people are selling, not buying. What is wrong with this picture? Let's take a look at another great company on sale. Look at Paychex. You know, a company that does payroll, human resources, and employee benefits. Not only is this a great growth stock, this company has increased earnings at the rate of just under 23%, going back since 1990, over 20 years. But look at this again, ladies and gentlemen. This company pays a 5.6% dividend, and historically, because of the consistency and quality of this growth, at any other time in the marketplace, the market has always priced this stock at a premium. It's the first time in 20 years you could buy this stock below its earnings justified level. At $23.60, this stock would normally be trading at $34 or $35, and you could pick up a 5.6% dividend yield. What a great bargain. What a great opportunity to buy another company, great company on sale. Now look at the dividend record of this company. Look how this company has just consistently, since 1993, increased their dividend year after year after year. If you'd have bought this stock and put $100,000 in this company back in January 31st, 1990, today it'd be worth over $3 million. That's averaging a 19.7% compounded rate of return. And look what's happened to the S&P. Over this 20-year period, the S&P would have only made you 4.1%. Obviously, this is more than 10 times as much money and more than 4 or 5 times the rate of return, compounded rate of return, when you include dividends. It's unbelievable what you can find today if you're willing to look. Don't let fear keep you from some of the best bargains of a lifetime. Guys, I got to tell you, I'm so sick of all the doom and gloom. I'm sick of all the talk about the recession. I'm sick of the media just inundating us with fear and just frightening headlines and exaggerated statements about slashing this and dumping that and collapsing this and how bad the crisis is. You know, there's some other statistics that we ought to be knowing. I always like to guide all my listeners to the goodnewseconomist.com. What a terrific new website where there are people that are actually giving us more learned analytical information rather than this emotional gripped, you know, multi-media fear and doom and gloom that the press is so fond of presenting to us today. So let me end today's blog with a statistic that's staggering. At the end of December, and I haven't seen January's number yet, there was $8.85 trillion on the sideline held in all investment accounts throughout the United States. That represents 74% of the market value of all public traded companies in the United States. The point is there is more money on the sideline now. It's almost 45% of the average portfolio than at any other time in history. And when you have that kind of money sitting on the sideline, just, you know, it's like a rocket ship sitting on the launching pad, you know, just shaking with smoke. At some point, that money is going to recognize that, you know, safety is great, but if they're going to meet their financial goals, they've got to opt for rate of return. And the only logical place for them to go is the stock market. And we believe the next 4 or 5 years are going to be some of the most exciting periods, especially for the right companies. We do believe you got to separate the wheat from the chaff. There are companies that are having terrible operating results, but there's 2 examples I showed you today. They're doing just great. You look at a company like Paychex or Aflac. They have no debt on the balance sheet. They generate strong cash flows, and the companies are literally selling at valuations that are unprecedented in their history. What a great time to be an investor if you have the courage and the common sense to not run out of the Walmart store, but to grab an extra shopping cart and load up on some of the best opportunities we've had since 1995. You know, this is Chuck Carvell. I thank you for listening.